Imagine a highly profitable, cash-generating technology business that literally powers the checkout for everything from MetLife Stadium to SpaceX's Starlink. We're talking about a business compounding its net revenue at 26% a year. Now, imagine watching that exact same stock violently crash nearly 19% in a single day, a drop that seems entirely disconnected from the fundamental resilience of its actual economic engine. That is the exact paradox we're unpacking in this explainer today. We are going to look under the hood of Shift4 Payments to figure out if the market just handed long-term investors a massive mispricing, or if there's a hidden danger lurking on the balance sheet that justifies the panic. To really understand the scale of this disconnect, we have to anchor ourselves in the severity of the drop. On August 6, 2024, Shift4 released its second quarter earnings, and Wall Street basically hit the panic button. The stock plummeted 18.77%, and it kept sliding the next day to close out at $41.26. But here's the really fascinating part. This wasn't some broken company reporting a collapsing business model. In fact, they beat expectations on several key operational metrics. So to understand why the market sold off so aggressively, we first need to completely understand how this company actually makes its money. Okay, let's dive into the core business. Shift4 Payments is not just some standard credit card swiper. They are an end-to-end commerce engine. They focus on incredibly complex, high-volume environments. Think luxury hotel resorts, massive professional sports stadiums, and busy restaurant chains. Historically, these massive enterprises had to deal with an absolute nightmare of fragmented legacy systems. You'd have one vendor for the payment gateway, a completely different one for the card acquirer, another guy for the hardware, and yet another for the software. Shift4 steps in and replaces all of that with a single unified technology stack. That dramatically lowers the operational complexity for the business owner, which is exactly why massive enterprises adopt them. Now, what's genuinely brilliant is Shift4's multi-layered monetization model. The primary economic engine is transaction-based processing. They earn a blended spread, which basically means taking a tiny fractional slice of the total payment volume routed through their systems. But they don't stop there. On top of those transactions, they layer highly predictable software as a service and subscription revenues from products like their SkyTab restaurant system and their VenueNext stadium software. And recently, they acquired a company called Global Blue, which adds an incredibly high-margin revenue stream from cross-border tax-free shopping and dynamic currency conversion. It's a compounding revenue machine. But here is where the true beauty of this business model lies, and it's absolutely crucial: the competitive moat. When Shift4 integrates its payments engine directly into a hotel's property management system or deeply into a stadium's primary ticketing platform like Ticketmaster, they become part of the central nervous system of that business. Ripping Shift4 out is operationally brutal. It's literally like trying to perform open-heart surgery on a hotel while it's fully booked. It creates incredibly sticky customer relationships with massive switching costs. That competitive moat is exactly how they defend their turf against some very heavy hitters. In the global digital space, they hold their ground against a giant like Adyen by being far superior in complex, in-person environments. In the restaurant space, they compete fiercely against Toast. Now, while Toast leads in sheer restaurant site count, Shift4 is actively winning larger enterprise restaurant accounts using a very smart wedge. They offer zero upfront hardware fees for their SkyTab system. This effectively makes Shift4's 5-year total cost of ownership less than a third of Toast's. It's a huge competitive advantage. And by the way, if you like deep, evidence-based stock breakdowns like this, make sure you're subscribed. Because here is where the story gets really interesting. If the business has this incredible competitive moat and a highly profitable operational core, why did Wall Street completely panic on August 6? What exactly is the central conflict here? Well, the market sphere boils down to 3 massive anxieties. First, in that Q2 2024 report, management actually revised their full-year guidance downward. They cut the midpoint of their net revenue guidance by about 200 basis points. Why? Because of a $25 million disruption in Middle East travel corridors and another $20 million headwind from foreign exchange translation. But the second factor is arguably the biggest boogeyman in the room: Shift4's balance sheet. The company is carrying a highly leveraged capital structure with $4.5 billion in debt. In a world where macroeconomic stability feels fragile, high leverage makes investors extremely nervous. So, let's look at the actual evidence from that Q2 2024 earnings report to see if that panic was entirely justified. The operational reality is that their top-line momentum is surging. Gross revenue less network fees, which is essentially the actual money they get to keep after paying the credit card networks, shot up 51% year over year to $624 million. Adjusted EBITDA hit a massive 46% margin. Non-GAAP earnings per share came in at $1.32, which actually beat analyst estimates. But look at the bottom line. GAAP earnings plummeted to just 8 cents a share, significantly missing estimates. So why the massive gap? Because of heavy interest expenses on that massive debt load, plus a $15 million quarterly dividend payment on their preferred stock. The core engine is wildly profitable, but the capital structure is currently eating those profits alive. When we synthesize all of this into a qualitative scorecard, the tension is obvious. Financial health scores a weak 5 out of 10 because of that tight 3.7x net leverage and limited interest coverage. However, look at management alignment. It is an exceptional 9 out of 10. The founder, Jared Isaacman, recently collapsed the company's multi-class share structure, eliminating his own super voting control. Even more incredibly, he explicitly waived $440 million in future tax receivable agreement payments, directly transferring those cash flows back to the balance sheet for the benefit of common shareholders. You rarely, if ever, see that level of alignment from a founder. Before we get into the valuation, all of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world, completely free at flash.stocksentinel.ai. The core company research is free. Now, if you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders for quality businesses built to compound for years, hidden gems for under-the-radar names with asymmetric upside, and dividend hunters for durable income with the fundamentals to back it up. Portfolio Watch monitors your portfolio and flags important changes, and Insider IQ tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this explainer. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases. All right, let's get into the 5-year framework. Remember, these are hypothetical scenarios to test our thinking, not a prediction or financial advice. We want to ask a very specific question here. If the business develops in these different ways, what might the stock plausibly be worth 5 years from now? Let's break down the operating assumptions. In our base case, we assume Shift4 successfully integrates its recent acquisitions and maintains stable blended spreads. Over 5 years, net revenue compounds at 15% annually, and Adjusted EBITDA margins slowly expand to 48%. If we apply a reasonable 8.5x exit multiple to those future earnings and assume they use their massive free cash flow to actually pay down that $4.5 billion debt load, the implied year 5 share price is $198.44. Now, if things go perfectly, the high case, international expansion absolutely explodes, margins hit 50%, and the stock could reach over $320. But we have to be realistic. In the low case, if competition from Toast squeezes margins down to 43% and those macro travel disruptions persist, the stock might only be worth around $70.90 in 5 years. So now we have 3 possible destinations 5 years from today. But there's another question, and arguably an even more fundamental one. The scenario analysis asks where the stock might trade in the future, but what are the cash flows this business could generate actually worth right now? $1 of cash generated 5 years from now is obviously worth less than $1 today because of time and risk. So we need to discount those expected future economics back to the present. To do this, we use a discounted cash flow, or DCF, model based on that base case operating path we just talked about. First, we project the unlevered free cash flows. They start at roughly $848 million in year 1 and grow to over $1.5 billion by year 5 as margins expand and top-line growth compounds. But because of that heavy debt load we mentioned, we have to assign a strict 12% weighted average cost of capital. We are basically placing a high hurdle on those cash flows to account for the risk. We then calculate a terminal value, assuming a very conservative 2% long-term growth rate after year 5. When you combine the discounted cash flows from the next 5 years with the discounted terminal value, you get an enterprise value of nearly $13 billion. But remember that balance sheet. We have to subtract $4.1 billion in net debt, plus over $1 billion in preferred stock claims to find out what's actually left for the common equity. When you divide that remaining equity value by the outstanding shares, you get a present base intrinsic value of $92.51 per share. Now, I want to be clear. A DCF is not an incredibly precise answer machine. It's a way to test our assumptions. If we demand a higher 13% discount rate because we're worried about the debt, the intrinsic value drops to around $70. If we use a lower 11% discount rate, it jumps over $105. But even with a strict 12% cost of capital and conservative 2% terminal growth, the fundamental math clearly points to $92.51. When we reconcile these two valuation lenses, it's pretty amazing. They are completely consistent with one another. The current market price sits severely compressed at 41.26. Our DCF model tells us that based on the cash the business is fundamentally expected to generate, it is worth 92.51 today. That means the market is heavily discounting the stock. And as the company continues to generate cash over time and actually pays down that debt load, our 5-year framework shows the equity compounding toward that 198.44 base case. The present value and the future value both point to the exact same story. The underlying economics are far stronger than the current stock price implies. But to be a smart investor, you absolutely have to know what could break this thesis. The risks here are very real. The most severe near-term risk is that debt load. With an interest coverage ratio of just 2.0x, Shift4 does not have a lot of breathing room if cash flows suddenly stumble. Secondly, they are a highly aggressive acquirer. Integrating a complex cross-border platform like Global Blue brings massive execution risk. If they fail to integrate smoothly, operating expenses will spike, and those 48% margin assumptions in our models will completely break down. Finally, any systemic disruption in global travel, like a renewed geopolitical crisis or pandemic, would directly hit their highest margin international revenue. So what is the ultimate takeaway here? We are looking at a stark disconnect. The market looked at a localized travel headwind and a highly leveraged balance sheet, and basically threw the baby out with the bathwater, crashing the stock 18% in a single day. But beneath the GAAP earnings miss and the macro fears lies an incredibly sticky, cash-generating commerce engine. They have dominant positioning in massive industries and unprecedented management alignment. If management can successfully integrate their acquisitions and use that massive free cash flow to delever the balance sheet, the math suggests the current $41 price tag dramatically undervalues both what the business is worth today and what it could become over the next 5 years. The market has priced Shift4 for disaster, but the fundamental math tells a story of massive cash generation. The only question left is, will Wall Street realize their mistake before the debt clock runs out, or is this a value trap waiting to spring? If you want the full research, including the complete 5-year scenario model and intrinsic value analysis behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.